You know what's fascinating? While everyone's been watching the stock market, something absolutely extraordinary has been happening with gold, and it's directly tied to a number that most people try to ignore, the U.S. national debt clock. Right now, as I'm recording this, the U.S. national debt has blown past $38 trillion. Let me say that again, $38 trillion. And gold? Gold just broke through $4,000 per ounce and is holding strong above that level. This isn't a coincidence. This is a mathematical relationship that's been building for decades, and we're now watching it play out in real time. Here's what nobody's talking about. There's a 0.95 correlation between the growth of U.S. national debt and the price of gold. For those who aren't statistics nerds, that's about as close to a perfect relationship as you get in financial markets. When debt goes up, gold goes up. It's that simple. But the speed at which this is happening now, that's what should have everyone's attention. Let me paint you a picture of what's really going on here. Every single day, the U.S. government is adding approximately $8 billion to the national debt. That's not a typo. $8 billion every single day. That's more than most countries' entire annual budgets. And the debt clock? It's not slowing down. It's accelerating. Now, here's where this gets interesting. Gold has surged more than 60% recently and is on track for its best annual performance since 1979. Remember 1979? That was right before gold hit its inflation-adjusted peak of over $2,000 per ounce in 1980 dollars, which would be over $8,000 in today's money. We're watching history repeat itself, but this time the fundamentals are even more extreme. Central banks around the world are watching this debt clock too, and they're not just watching, they're acting. Central bank gold purchases have been at record levels. We're talking about hundreds of tons of physical gold being accumulated by countries like China, Russia, India, and Turkey. These aren't small players making emotional decisions. These are sophisticated institutions with teams of economists who understand exactly what's coming. Why are they doing this? Because they understand something that most retail investors are just starting to figure out. When debt reaches these levels, there are only three ways out. You can grow your way out, but with debt to GDP ratios above 120%, that's mathematically impossible. You can default, but that would collapse the entire global financial system. Or you can inflate your way out, and that's exactly what's happening. Think about what inflation really means. It's a hidden tax on everyone holding dollars. When the government creates more money to service its debt, every dollar you own becomes worth less. It's not that things are getting more expensive. It's that your money is becoming less valuable. And gold? Gold is the market's way of pricing in this devaluation. Let me give you some specific numbers that should make this crystal clear. Back in 2000, the U.S. national debt was about $5.6 trillion. Gold was trading around $280 per ounce. Fast forward to today, debt is at $38 trillion and gold is above $4,000. That's a nearly 7x increase in debt and a 14x increase in gold. Gold has actually outpaced the debt growth. Why? Because the market is pricing in acceleration. The market is pricing in the fact that this debt spiral is entering its final, most dangerous phase. Here's something that should terrify anyone paying attention. The interest payments on the national debt have now exceeded $1 trillion annually. That's more than the U.S. spends on defense, more than it spends on Medicare. The government is now borrowing money just to pay the interest on money it already borrowed. This is the definition of a debt spiral. And here's the kicker. Interest rates are still historically elevated. The Federal Reserve has been cutting rates, sure, but they're nowhere near the zero-rate environment we had for years. Every percentage point of interest rate translates to hundreds of billions in additional debt service costs. The government is trapped. They can't afford high rates, but they also can't afford the inflation that comes with low rates. This is where gold comes in as the ultimate pressure release valve. When investors lose confidence in a currency, they don't just sit there and watch their wealth evaporate. They move into hard assets. And the hardest asset of all, the one that's been money for 5,000 years, that's gold. Let me tell you a story that perfectly illustrates this dynamic. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. At that moment, gold was $35 per ounce. The U.S. national debt was $398 billion. Within 9 years, by 1980, gold had skyrocketed to $850 per ounce, a 24x increase. The debt had grown to $908 billion, only a 2.3x increase. Gold massively outperformed the debt growth because the market was pricing in the loss of discipline that came with leaving the gold standard. We're in a similar moment right now, except the numbers are exponentially larger. The debt isn't growing linearly, it's growing exponentially, and gold is starting to price that in. When Moody's downgraded the U.S. credit rating recently, gold didn't crash. It held its ground and even pushed higher. That's a massive signal. The market is telling you that the traditional safe haven, U.S. Treasury bonds, is no longer as safe as it once was. Here's what's really fascinating: the ratio of U.S. debt to gold. If you took all the gold held by the U.S. government, about 8,100 tons, and valued it at current market prices, it would cover less than 3% of the national debt. Think about that. The entire gold reserve of the United States couldn't even make a dent in the debt. This is why some analysts are predicting gold could go to $5,000, $10,000, or even higher. The math simply doesn't work at current prices. Now, I want to take a quick moment here because this is relevant to a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, 401ks, IRAs, that kind of thing, you might want to look into how gold IRAs work. I put together a free guide that's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. It's worth understanding your options, especially given what we're seeing with the debt situation. All right, back to where this is all heading. The institutional money is starting to flow into gold in a way we haven't seen in decades. Gold ETFs, after years of outflows, are seeing renewed demand. But here's what's even more significant: the physical market is tightening. Premiums on physical gold coins and bars have been elevated. Delivery times are extending. This is classic supply-demand dynamics playing out in real time. And it's not just gold. Silver has broken to decade highs. The entire precious metals complex is moving because smart money understands that we're in the early stages of a currency crisis. Not a dollar crisis specifically, a fiat currency crisis. When every major economy is running massive deficits and printing money to cover them, there's nowhere to hide except in assets that can't be printed. Let me give you another historical parallel. In 2008, during the financial crisis, gold initially sold off as everything did. But then something interesting happened. As central banks around the world launched unprecedented stimulus programs, quantitative easing, zero interest rates, massive deficit spending, gold went on a tear. From 2008 to 2011, gold went from around $800 to over $1,900. It more than doubled in 3 years. What's different now? The stimulus is even larger. The debt levels are even higher. The Fed's balance sheet is still massive despite their attempts to reduce it. And the political will to address the debt problem? It's non-existent. Both parties are committed to spending. Nobody wants to be the one to cut benefits or raise taxes. So the debt keeps growing, and gold keeps pricing in the inevitable outcome. Here's a question worth considering. What happens when foreign central banks stop buying U.S. Treasury bonds? For decades, countries like China and Japan have been the largest foreign holders of U.S. debt. They've been financing America's deficit spending. But recently, we've seen them reducing their holdings. China has been steadily selling treasuries. Japan has been forced to defend its own currency. Who's going to buy all this new debt that's being issued? The answer is the Federal Reserve. They'll have to step in and buy it themselves, which is just a fancy way of saying they'll print money to buy government bonds. This is called debt monetization, and it's the final stage before a currency crisis. It's what happened in Weimar Germany. It's what happened in Zimbabwe. It's what happened in Venezuela. The scale is different, but the mechanism is the same. Now, I'm not saying the dollar is going to collapse tomorrow. The dollar is still the world's reserve currency. It has enormous structural advantages, but those advantages are eroding. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternatives to the dollar for international trade. They're settling oil transactions in yuan. They're creating new payment systems that bypass SWIFT. They're accumulating gold as a neutral reserve asset. This is the context in which gold is moving. It's not just about inflation or interest rates or any single factor. It's about a fundamental shift in the global monetary system, and gold is the asset that benefits when that system is in flux. Let me break down what the technical analysts are seeing right now. Gold broke through major resistance at $3,800, then $4,000. These weren't just psychological levels, they were areas where massive amounts of selling had occurred in the past. Breaking through them signals that new buyers are entering the market at higher prices. That's bullish. The next major resistance level? Most analysts are looking at $4,300 to $4,500. But if we get a real crisis moment, a debt ceiling standoff, a major bank failure, a geopolitical shock, gold could gap much higher very quickly. Here's something that doesn't get enough attention. The gold mining stocks are still relatively cheap compared to the gold price. Historically, mining stocks leverage the gold price. They move 2x or 3x as much as gold itself. But right now, many quality gold miners are trading at valuations that suggest gold at $3,000, not $4,000. This disconnect usually doesn't last. Either gold comes down or the miners catch up. Given the debt dynamics we're discussing, I'd bet on the miners catching up. The supply side of gold is also fascinating right now. Gold mine production has been relatively flat for years. It takes 7 to 10 years to bring a new gold mine online, and there aren't many major discoveries happening. Meanwhile, demand is surging. From central banks, from ETFs, from Asian retail buyers, from industrial applications. When supply is constrained and demand is increasing, there's only one direction for price to go. Let's talk about what this means for the average person. If you're holding cash, you're losing purchasing power every single day. The official inflation numbers might say 3% or 4%, but anyone who buys groceries or pays rent knows the real number is much higher. Your savings account paying 4% interest isn't keeping up. You're going backwards. If you're in bonds, you're facing a different problem. Yes, you're getting yield, but you're also exposed to interest rate risk and credit risk. If rates go up, bond prices go down. If the government's creditworthiness deteriorates further, bond prices go down. You're basically betting that the debt situation stabilizes or improves. Based on what we're seeing, that's a losing bet. Stocks are interesting. Some stocks will do well in an inflationary environment, particularly companies with pricing power, hard assets, or commodity exposure. But the overall market is expensive by historical standards, and it's vulnerable to a debt crisis. If the government is forced to cut spending or raise taxes dramatically to address the debt, that's going to hurt corporate profits and consumer spending. Gold, on the other hand, thrives in exactly this environment. It's not someone else's liability. It doesn't depend on a government's promise or a company's earnings. It's just gold. It's been valuable for thousands of years, and it will be valuable thousands of years from now. That's why it's called a store of value. Here's a thought experiment. Imagine you're a central banker in China or Russia or India. You're watching the U.S. debt clock tick higher every second. You're watching the U.S. government struggle to pass budgets, fight over debt ceilings, and print money to cover deficits. You're holding trillions of dollars in reserves. What do? You diversify. You buy gold. You reduce your dollar exposure. You prepare for a world where the dollar isn't the only game in town. That's exactly what's happening. And it's accelerating. The pace of central bank gold buying has been extraordinary. These institutions are voting with their wallets, and they're voting for gold. They understand that the debt clock isn't just a number. It's a countdown to a monetary reset. Now, some people will say, but gold doesn't pay interest. It doesn't generate cash flow. It just sits there. That's true. But that's also the point. In a world where every financial asset is someone else's liability, where every currency is being debased, where every government is drowning in debt, having an asset that just sits there and maintains its value is incredibly powerful. Gold is financial insurance. You don't buy insurance hoping to use it. You buy it hoping you never need it. But when you need it, you're really glad you have it. The correlation between the debt clock and gold price isn't just a statistical curiosity. It's a fundamental relationship that reflects how markets price in monetary debasement. Every $1 trillion added to the debt is another trillion reasons to own gold, and we're adding trillions faster than ever before. Here's what I'm watching going forward. The debt ceiling debates, the Federal Reserve's policy decisions, the pace of central bank gold purchases, and the physical gold market premiums. These are the indicators that will tell us if this gold rally has legs or if it's just a temporary spike. Based on everything I'm seeing, this isn't temporary. This is the beginning of a major repricing of gold relative to fiat currencies. The U.S. debt to GDP ratio is now above 120%. That's higher than it was after World War II. Back then, we grew our way out of it with a booming post-war economy and favorable demographics. Today, we have an aging population, slower growth, and political gridlock. The path forward is much more challenging. Some analysts are predicting gold could reach $5,000 to $10,000 per ounce if the debt spiral continues. That might sound crazy, but remember, gold went from $35 to $850 in the 1970s. That's a 24x increase. A move from $4,000 to $10,000 is only a 2.5x increase. Given that the debt is exponentially larger now, that doesn't seem unreasonable at all. The key thing to understand is that gold isn't going up. The dollar is going down. Gold is just maintaining its purchasing power while the currency loses value. An ounce of gold has always bought roughly the same amount of goods and services throughout history. It's the paper currencies that fluctuate wildly in value. Think about it this way. In 1920, $20 could buy you a nice suit. Today, $20 barely buys you lunch. But an ounce of gold in 1920 could buy you a nice suit, and an ounce of gold today can still buy you a nice suit. That's the power of gold as a store of value. It preserves purchasing power across generations. The debt clock is ticking. Every second, it's adding thousands of dollars to the national debt. And every second, gold is adjusting its price to reflect the diminishing value of the currency that debt is denominated in. This isn't a conspiracy theory. This isn't doom and gloom. This is just math. And the math is undeniable. What we're witnessing is a slow-motion currency crisis. It's not happening overnight. It's happening gradually, then suddenly. We're still in the gradual phase, but the sudden phase is coming. When confidence breaks, when foreign central banks accelerate their dollar diversification, when the Fed is forced to choose between defending the currency and funding the government, that's when things get really interesting. Gold is telling us something important right now. It's telling us that the market is losing confidence in the ability of governments to manage their debt. It's telling us that inflation is going to be higher for longer than officials are admitting. It's telling us that we're entering a new monetary era where hard assets matter more than financial assets. The reaction of gold to the debt clock isn't shocking when you understand the fundamentals. What's shocking is that more people aren't paying attention. What's shocking is that mainstream financial media is still treating gold like a barbarous relic instead of recognizing it for what it is, the ultimate form of money that can't be printed, debased, or defaulted on. So here's the bottom line. The U.S. national debt is at $38 trillion and climbing fast. Gold is above $4,000 and holding strong. The correlation between these two numbers is 0.95, nearly perfect. Central banks are accumulating gold at record rates. The physical market is tightening. The technical picture is bullish. And the fundamental case, the debt spiral, the monetary debasement, the loss of confidence in fiat currencies, is stronger than ever. This isn't about timing the market perfectly. This isn't about trying to catch the exact bottom or top. This is about recognizing a major structural shift in the global monetary system and positioning yourself accordingly. Gold has been money for 5,000 years. The dollar has been the reserve currency for 80 years. Which one do you think has more staying power? The debt clock is sending a message. Gold is receiving that message loud and clear. The question is, are you listening?